Guys, welcome back to section 2 of chapter 4 with business studies with AARevision. So we've left off at inflation. Now we're going to go on to interest rates. So the definition of interest rates is the price of borrowed money or the reward for savings. So example, I'm going to put in an example to help you out. So if you borrow £10,000, say you want to hire a building? A premises, that's the word. So an interest rate of 5% is added. So for the end of the year, 5% of £10,000 is 500, and so you add on your interest rate percentage onto the cost that you borrowed. So 10,000 plus 500 equals 10,500. So I know interest rates are higher on borrowing and lower on savings. You never actually see a year where you get £10,500. If you left that £10,000 in a bank, you'll probably only get about, I'd say, maybe £1 a month. So basically interest rates aren't really effective on savings. It is better on borrowing because obviously the firm, or the bank in this case, will generate more profits or income or whatever it is. So, higher interest rates leads to less demand for borrowing, because if your cost of interest rates are higher, you're not going to borrow more because you're going to have to pay more back in the future, like I've mentioned here. So 10,500 is kind of a lot-ish. You're paying £500 more for borrowing £10,000. And so this leads to less investment and consumption by businesses and firms. So because it's more expensive, because there's higher interest rates, they're going to charge you higher in order to pay it back, and that decreases investment and consumption by businesses. So demand in the economy decreases because you're not actually investing. Investing is a component of which demand is increasing, if that makes sense. And then businesses cut production or slow it down because interest rates are more expensive to actually pay back in the future, and therefore you've got to cut down your production if you're actually borrowing money in order to help your business go further. And the opposite happens if there's lower interest. So if there's lower interest, increase for demand for borrowing will increase. People will spend more, people will invest more. They are optimistic. And note that pessimism or pessimists is when you have negative confidence. So higher interest rates will give them a pessimist sort of view on businesses. So business pessimism, because they're not really confident about borrowing and investing. Exchange rates. Now this I wanted to simplify a lot because it is actually so much more easier than you actually think. So the only thing that you need to know is spiced and WIPDEC, or YDEC is what I used. Spiced stands for strong pound, imports cheaper, exports dearer. So it means your imports are cheaper if there's a stronger pound, and exports are dearer, means more expensive. As long as you know if you've got the cheaper part, then you're fine. Just remember spiced, and remember that the opposite of this, WIPDEC, which means weaker pound, imports dearer, meaning more expensive, and exports cheaper. As long as you know that, you are fine with exchange rates. Trust me, I've used this all the time. It never lets me down. So the definition of this is the price of one currency expressed in terms of another. So say a pound equals $1.46. So for an example of what a stronger pound is, or a weaker pound, I've given this little definition. So £1 will buy you $1.50. And then in the future, say £1 will buy you $2. It means there's a stronger pound because there's an increase from $1.50 to £2. So if a glue stick in the UK was a pound, in what's it called? I don't know. Who uses a dollar? Canada? Canadians? Maybe? Oh my god, how do I not know this? Anyways, so basically your pound is stronger, and therefore you would use this phrase. So stronger pound, imports are cheaper. So it is better for your country to import more if that is your current euros. So you know when you're going on holiday, you type up on Google how much £300 will convert into euros or into dollars. According to what it is, you'll know if your currency is stronger or weaker. So stronger pound, imports are cheaper. So importing businesses or consumers, they want a stronger pound only because their imports will be cheaper. It will be cheaper for them in terms of profits. Exporting business or consumers want a weaker pound because exporting is cheaper, but for the country, importing is dearer. I don't know if you might need to know this for business, but it might be useful. If like imports are dearer, meaning more expensive, and your exports are cheaper, it means your economy is at a balance of trade surplus. And if it's the opposite, it's a deficit. You don't need to know too much of this in business, so I'm not going to go into detail, but if you want to know, check it out or comment below and I might make a separate video on this, or Google it. It is about balance of trade or balance of payment, surplus and deficit. Oh, sorry. So, the last bit. So, government spending and taxation. I've simplified this. So, increasing government spending. So, it is the government spending on the healthcare sectors, education, defence. This is good because they are investing into the economy. This creates more jobs. If they invest into the education system and they create more schools and stuff, then teachers will get employed, there's more employment, pupils will have an education, and this is good government spending. It's good that they're investing in the economy. It's bad on welfare payments. Welfare payments is like benefits, so like if you're not working, so job seekers allowance, it's a disincentive, because if you're getting welfare payments and if there's an increase in welfare payments, it creates a disincentive for people to actually work. And if there's less people working in your economy, this leads to higher unemployment, as we talked about in the part 1 of this section. Decreasing taxation. So there's two types. There's direct taxation and indirect taxation. With direct taxation, it is income tax and corporation taxes. Income tax is taxes placed on your income. So say if you earn £40,000 a year, there's a specific amount that you have to pay back to the government. So that's your income tax. Corporation tax is taxes based on profits. So this applies to firms. So the same thing. So if there's a decrease in these sort of taxations, you have more disposable income. You've got more money, basically. Disposable income is money after taxes usually. So there's more income and therefore you can spend more, consumption increases, demand for businesses. So you've got more money. You might buy more glue sticks from Pritt. I think I'm slightly advertising here. It's only because I've got it in my hand. Indirect taxation, so this is VAT, card tax, insurance tax, excise duties. So excise duties is like alcohol and, what is it? Is it cigarettes and stuff? I'm not too sure. Let me just double check on that. Petrol, so petrol and alcohol, because you know that with alcohol they tax kind of a lot because they don't want you to do it, so don't do it. So, with VAT, car tax, insurance tax, excise duties, this increases demand too because it's the same. So, if they decrease it, so VAT is like, everything you buy, there's some sort of VAT. There's like 20% that they add on, which you get charged for. So, if there's less, goods and services are cheaper. So, say if this Pritt glue stick was £2.50 and then they reduce their VAT by 10%, then you will know that the prices of these Pritt sticks will decrease, and you're like, why did they decrease? But they decrease, so I might as well buy more glue sticks. Well, hey! So, I don't know why you'd need to buy more glue sticks unless you need to stick things, but you get my point, I hope. So, that is it, guys! I hope you enjoyed that. Well, I hope it benefited you for the exam, which it should, because I think this was really useful. So make sure you subscribe and like my videos and stay tuned, and thank you guys. See you for chapter 5, financing the new business idea. Bye bye.